Imagine you are staring at your screen right now, and you have a stock pulled up that is just screaming contradiction at you.
Oh, completely. It's wild.
Right. Because on one hand, you have these short-term momentum indicators aggressively flashing sell. You are looking at a company battling massive industry-wide inflation. And you check their recent earnings report, and they just posted an absolutely staggering quarterly loss.
Yeah, it's just bleeding cash.
Exactly. It looks, by all conventional metrics, like a textbook disaster.
Right.
But then you scroll down to the insider trading filings, and you see that the CEO of this exact same company just reached into his own pocket and bought 1 million shares with his own money.
I mean, it is arguably the most fascinating dynamic you can find in the market right now. You have like alarms blaring in the engine room, right? The analysts on Wall Street are basically standing on the deck handing out life jackets.
Yeah.
And yet the captain of the ship is aggressively buying up more cargo. It's insane.
So today, we are tackling the billion-dollar question. Is Oscar Health ticker symbol OSCR a deeply undervalued gem hiding in plain sight? Or is it just a classic value trap waiting to snare retail traders who think they are getting a bargain?
A bargain that could stay cheap forever, yeah.
We are tearing through a massive stack of data on Oscar Health as of today, April 20, 2026. We are looking at the price action, the income statement, the balance sheet, and the analyst ratings to figure out what is genuinely driving the valuation here.
And to really understand this, we have to look past the superficial noise, We are looking at a brutal collision between staggering top-line growth, severe margin compression, and an insider conviction that, frankly, just defies the broader macroeconomic headwind.
Right. Before we jump into the charts, though, just some quick housekeeping. Hit that like button, subscribe to our YouTube channel, and drop your feedback in the comments. We consider it a compulsory part of joining this deep dive community.
You gotta pay the engagement tax.
You do. And a crucial reminder, we are here debating the data strictly for your education and entertainment. This is absolutely no financial advice.
Okay.
So let's establish the current reality. As of right now, OSCR is trading at $15.79, which is up about 1% on the session.
Sitting right in the middle of its 52-week range, too, which is $10.69 to $23.80.
Right. And it has a market cap of $4.70 billion.
Yeah.
But looking at the chart, it seems trapped in a very tight box.
Trapped is the perfect word for it. The stock has successfully broken out of a longer-term weekly descending channel, which is undeniably a bullish development.
Definitely.
And it is trading confidently above its 50-day moving average of $13.33.
Yeah.
So that creates a very sturdy technical floor. Like between $13.80 and $14.29, you have this solid block of major support. The buyers approving they will step in at that level.
Which is great, but I'd actually argue the ceiling is a much bigger story than the floor right now.
Oh, the 200-day.
Yes. Because, yes, the floor is sturdy, but it is inches away from smashing its head into a massive ceiling. At $15.79, it is staring directly at the 200-day moving average, which is sitting at $15.85.
It's literally right there.
It's trapped in a $2 box, and that 200-day is notoriously difficult to break without a massive catalyst.
And that is exactly why the chart is presenting such a dilemma. I mean, the 200-day moving average isn't just, a line on a screen. It represents the long-term institutional memory of the stock.
Right. It's where the big money is.
Exactly. Breaking through that requires immense, sustained buying volume from major funds. It requires a shift in fundamental thesis, not just retail momentum. And right now, the momentum indicators suggesting the buyers might be, running out of gas.
Totally. Looking at the RSI pushing 68.30 and the MCD showing clear deceleration, the momentum's exhausted. I mean, some trading platforms are auto-generating sell signals right now based on this.
Yeah, the short-term indicators are definitely flashing red.
My read on this is that retail traders pushed it out of that weekly channel, felt great about the recovery, but now the big money is stepping in at that 200-day moving average, unloading their bags and capping the rally. How do you not look at those conflicting signals and see a stock about to roll over?
Well, that is a very valid read on the short-term exhaustion, I'll give you that, but consider the mechanics of a reaccumulation phase.
Okay, walk me through it.
When a stock breaks out of a prolonged downtrend, it rarely slices cleanly through major resistance. It surges, hits a wall like the 200-day moving average, and then chops sideways. This is the absorption process.
So people are just trying to get out of break even.
Exactly. The buyers who got trapped at $18 or $20 a year ago are finally seeing the price approach their break-even point, and they are desperately selling just to get their money back.
Right.
But the fact that the stock is absorbing that selling pressure and holding near $15.79 rather than violently rejecting off the 200-day, that suggests that institutional buyers might actually be quietly accumulating underneath.
Interesting. So the chart tells us institutional buyers and sellers are essentially locked in a stalemate at $16. To understand why they are refusing to bid it up past that level right now, we have to pivot to the financials.
Yeah.
We need to look at the cash burn.
Oh boy. And this is where the fundamental story becomes incredibly polarized. Let's look at the fiscal year 2025 income statement.
Let's do it.
The top-line revenue growth is phenomenal. I mean, they generated $11.7 billion in revenue, which is up 27.5% year over year.
That's huge.
It is. For a company with a $4.7 billion market cap, pulling in nearly $12 billion in sales is a massive footprint. They also generated $1.09 billion in cash from operations. The revenue engine is undeniably firing on all cylinders.
I see where you're going with the top line praise, but let's pause on that because $11.7 billion in revenue sounds great until you realize the bottom line bleeding is horrific.
Yeah, the net losses are brutal.
Brutal is an understatement. For FY 2025, they posted a net loss of $443.2 million. And the truly alarming part is the concentration of that loss. Q4 of 2025 alone accounted for a $352.6 million loss.
Just in one quarter.
Almost the entirety of the year's failure to turn a profit happened in the final 3 months.
Which translates to an EPS of negative $1.24 just for that fourth quarter. It is a severe bleed, you're right, but if you look at the balance sheet, they do have a buffer.
Okay, what kind of buffer?
Well, total assets are sitting at $6.33 billion, supported by a highly liquid $3.99 billion in cash and investments. Against that, you have total liabilities of $5.34 billion, so that leaves about $980 million in shareholders' equity.
Okay, so they aren't going bankrupt tomorrow.
Right. They have the runway to sustain these losses for a bit, but the core issue is the structural unit economics.
Yes, which brings us to the most critical metric in this entire deep dive. The medical loss ratio, or MLR. For the full year, it was 87.4%, which is high. But in Q4, that MLR spiked to a back-breaking 95.4%.
Yeah, that is a tough pill to swallow.
An MLR of 95.4% isn't just a low-margin business. It's like running a casino where the house edge has shrunk to practically zero.
That's a great way to put it.
You're bringing in billions of dollars in bets. That's your massive $11.7 billion top-line revenue. But the players are hitting the jackpot so often, you're paying out 95.4 cents on every single dollar wagered. You can not keep the lights on, pay the dealers, fund the marketing, and run the security with a 4.6 cent margin.
The casino metaphor hits the nail on the head because it illustrates the concept of risk pooling perfectly. Top-line revenue is entirely irrelevant if the cost of delivering the core service consumes the entire premium.
Exactly.
Now, to understand why the MLR spiked so violently in Q4, we have to look at the mechanisms of health insurance. A significant portion of this is seasonal.
How so?
Throughout the year, patients are paying out of pocket to hit their deductibles, right? By the fourth quarter, deductibles are met. So patients rush to schedule elective surgeries, knee replacements, delayed treatments before the year ends.
Oh, so they don't have to pay out of pocket again in January.
Precisely. So the insurer suddenly goes from collecting premiums with minimal payouts to covering 80% or 100% of major medical bills.
Okay, but seasonality happens every year to every health insurer.
Yeah.
A 95.4% MLR suggests something structurally broke in Q4 beyond just people getting their end-of-year knee surgeries.
You're exactly right. The other massive factor dragging them down was significant risk adjustment accruals in FY 2025.
What does that mean for them?
Well, in the Affordable Care Act exchanges, risk adjustment is designed to level the playing field. If you end up insuring a demographic pool that is mathematically healthier than the state average, you actually have to pay money into a pool to subsidize the insurers who ended up with sicker, more expensive patients.
Wait, so they are penalized for having healthy members?
Effectively, yes. Oscar Health clearly faced headwinds with these risk adjustments, which acted as a massive vacuum on their margins in Q4.
Which logically means investors should be terrified. If you have practically non-existent margins and you are bleeding $350 million in a single quarter, the natural reaction is to abandon ship.
Run for the hills.
Exactly.
Yeah.
But this is the massive contradiction we highlighted at the start. While the fundamental data screams run, the insider data screams buy. Let's talk about the CEO, Mark T. Bertolini.
The magnitude of his purchase cannot be overstated. In early 2026, he stepped into the open market and bought 1 million shares at an average price of $11.92.
That is almost $12 million of his own personal wealth.
It's a massive bet.
Looking at the valuation metrics, my immediate thought is that he sees a glaring disconnect between the stock price and the underlying business scale. He's looking at an industry that traditionally trades at roughly 3x revenue, and he's betting that if he just tweaks the operational margins slightly, this stock will triple to match its peers. Is that the play here?
That is precisely the thesis. Look at OSCR Health's price-to-sales ratio over the last 12 months. It is sitting at a staggeringly low 0.4x. Now, compare that to the broader health insurance sector average, which trades at a multiple of 2.9x. You have a company that has compounded its revenue at a 49% annual growth rate over the last 5 years, yet it is trading at less than half of 1 times its sales.
So it looks incredibly cheap.
Very. If you are the CEO and you know the internal strategy to optimize that medical loss ratio, buying at 0.4x sales feels like stealing.
But here is the friction. If the valuation is that obvious and the top-line growth is that strong, Wall Street should be upgrading the stock aggressively.
You would think so.
Yet the consensus from 17 analysts is just a collective shrug. We are looking at a consensus hold rating. There are 3 buys, 8 holds, and 6 seller underperform ratings.
Yeah, they are not convinced.
And the average price target is exactly $16, which is practically where it's sitting today. If the CEO is willing to risk $12 million at $12 a share, what do those 6 bearish analysts see that he is supposedly blind to?
The disconnect stems from what each party is analyzing. The CEO is looking internally, right? He's looking at his technology stack, his member acquisition costs, and his strategic roadmap.
Okay, and the analysts?
The analysts are looking externally at the macroeconomic environment, and the external environment for health insurers right now is incredibly hostile.
Let's break that down into the ultimate debate. We have this massive divergence. A CEO betting millions on a turnaround, while analysts are pointing to a structural cliff. Give me the mechanics of the bear case. Why is this a value trap?
The trap is that OSCR Health is a casualty of systemic forces they just cannot control. Moody's recently issued a negative 2026 outlook for the entire health insurance industry.
That's a big deal.
It is. We are seeing brutal medical cost inflation, specifically in the ACA exchanges and Medicare Advantage. The hospitals, the doctors, the pharmaceutical companies, their costs to operate have skyrocketed, so they're demanding higher reimbursements. But at the same time, the rates that insurers are allowed to charge, or the payments they receive from the government, are strictly regulated and are lagging far behind that inflation.
So the underlying cost of healthcare is inflating faster than OSCR Health is legally allowed to raise their premiums to cover it.
Precisely. The bear case argues that a 0.4x price-to-sales ratio isn't a discount. It is a reflection of a permanently impaired business model.
So it's cheap for a reason.
Exactly. Retail traders get trapped because they see a quote-unquote cheap stock. They ignore the fact that in a risk-off market environment, facing a negative sector outlook from Moody's, a stock with 0 profit margins can stay cheap indefinitely. Valuation alone is not a catalyst.
I hear the structural headwinds, but I will take the other side of this trade. The bull case for a massive recovery is equally compelling, especially when you factor in their technology. First, a 27.5% year-over-year revenue bump is incredibly rare for a company doing $11 billion in sales. They are rapidly capturing market share. Second, from a technical perspective, breaking out of a long-term falling channel proves that the selling exhaustion is real.
And if you look at management's long-term guidance, they're targeting a 20% revenue compound annual growth rate and a 5% operating margin by the year 2027.
But let's be deeply skeptical of that for a second.
Fair enough.
Can they actually hit a 5% operating margin by 2027 if inflation keeps driving up the core cost of care? Or is that 2027 target just a rosy projection designed to keep institutional investors from abandoning ship today?
It's a valid question.
Because if that MLR stays pinned at 95%, talk about a 5% operating margin in 2027, is pure fantasy.
That tension is the crux of the entire investment thesis. The bull argument hinges entirely on the concept of scale. OSCR Health has built its identity on being a tech-forward insurance platform, right?
Yeah, the disruptor angle.
Exactly. The theory is that as they scale their member base, massively hitting that 11.7 billion mark, their fixed administrative costs shrink as a percentage of revenue. More importantly, that massive scale gives them the negotiating leverage they need to force hospitals and providers to accept lower reimbursement rates. which ultimately fixes the MLR.
Okay, what's the counter to that?
The bear counterargument is that their technology moat just isn't deep enough to offset the sheer force of government rate cuts and hospital inflation.
Well, the incredible part of this setup is that we don't have to wait until 2027 to see who is right. The market is going to force an answer very shortly. We have a massive, immediate catalyst right around the corner.
Yes, the volatility is about to compress dramatically. The Q1 2026 earnings report is scheduled for May 6, 2026.
So just a few weeks away.
Yep, and right now, analysts are modeling for an EPS of positive $1.16.
Wait, a positive EPS of 116 after they just posted a catastrophic negative $1.24 in Q4?
It sounds totally contradictory, I know, but remember the seasonality mechanics we discussed earlier?
Oh, right.
Q1 is historically the most profitable quarter for health insurers. On January 1st, everyone's deductibles reset to zero. For the first few months of the year, patients are paying entirely out of pocket for their care, while the insurer continues to collect the monthly premiums.
So a positive EPS is entirely expected.
Yes, the market won't react to the EPS number itself. The violent reaction will come from the updated 2026 guidance.
Right, because that May 6th report is going to reveal the truth about Q4. Was that 95.4% MLR just a localized seasonal anomaly driven by year-end surgeries and a one-time risk adjustment? Or was it the beginning of a permanent structural crisis where inflation is eating the core business alive?
If the MLR comes in hot again, validating the bears, that 200-day moving average at $15.85 is going to act like an unbreakable brick wall, and the stock will likely retrace back down to its lower support level.
It'll fall apart.
Exactly, but if management proves they have stabilized the medical costs and the tech stack is actually driving efficiencies, the shorts are going to be caught off guard. A short squeeze, pushing the price cleanly above that $16 level, could trigger a massive influx of technical buyers.
It is the ultimate pressure cooker. You have a stock physically trapped between explosive top-line revenue growth and razor-thin bleeding margins.
It is a pure test of conviction. You are weighing macro-level industry fear against micro-level insider confidence.
So as we wrap up this deep dive into OSCR Health's data, I want to leave you with one final thought to mull over. And it really has to do with the core identity of the company itself.
The tech identity.
Yeah. OSCR Health bills itself as a disruptor. A tech company fixing the archaic world of health insurance with better apps, better algorithms, and a superior user experience. But if OSCR Health's tech-driven platform is truly the future of insurance, why haven't legacy giants like United Health or Elevance, who have infinitely deeper pockets, simply replicated their app interface and crushed them?
It's a great point.
Is OSCR's true moat really its groundbreaking technology? Or is its only real competitive advantage just a willingness to operate at massive losses to capture market share? Because if it's the latter, the turnaround story might be much harder than the CEO is betting on. Keep an eye on that May 6th earnings report. We'll see you on the next deep dive.